If you've been searching for ways to make more dividend income, then you've definitely come across these two ETFs, the Goldman Sachs NASDAQ 100 Premium Income ETF GPIQ or the NEOS NASDAQ 100 High Income ETF QQQI. I've already done a video on QQQI, which I will post at the end of this, but it feels like more than ever, dividend and income focused investors are pouring into these two ETFs. Today I'm going to compare these two and discuss the income consistency, the strategies and objectives, the tax implications, and if you stick around to the end, we'll learn if you invest $10,000 into each one of these, which one is going to have a higher price appreciation and which one is going to have more dividend income. So if you're interested in potentially adding one or both of these to your portfolio, you'll definitely want to stay tuned to the end to figure out which one is a perfect fit. But before we get started, welcome back to the channel where we discuss how to grow our portfolios for the ultimate portfolio payday. Just remember, I'm some random dude on the internet, so always make sure to do your own due diligence before you invest any of your hard-earned money in the markets. What we discuss here may work for my portfolio, but it might not work for yours. So let's get started. GPIQ and QQQI are two of the most popular covered call ETFs around currently on the market. For today's sake of time for this video, I'm not going to go into what a covered call ETF is. There's a ton of information on the internet, but if you're really interested, leave me a comment below if you'd like me to do a video explaining just what it is. But cliff notes, these funds buy stock and sell covered call options on them. There's high income potential, but also limited upside price appreciation. These two ETFs are extremely similar in the fact that the basis of their fund is the NASDAQ 100. There's also a lot of differences between the two, so there may be some things that you like and fit into your investment strategy, and there's probably other things that you don't. Starting off, let's look at the Goldman Sachs NASDAQ 100 Premium Income ETF. GPIQ has only been trading for a short amount of time. The inception date was October 24th, 2023. But up until this point, it's done very well and definitely becoming one of the most popular favorites I've seen on the internet. The objective of this ETF is to seek current income while maintaining prospects for capital appreciation. This basically means that they're going to generate income by selling covered calls while simultaneously trying to actively manage their positions to grow the share price. Reasons to consider investing: they seek consistent monthly distributions. They aim to generate a consistent monthly distribution rate, generally from options premium and equity dividends. This ETF is trying to maintain a consistent monthly distribution rate. It's currently at a 9.89%. Looking at the history of this ETF, it's been relatively steady, ranging from 37 cents a share to 44 cents. There haven't been any major fluctuations that are concerning to this point. The consistent income is extremely important for an investor who relies on dividends in order to know just how much income you're actually going to make. If you have bills that are coming up in a couple months and you really need this income, you know that GPIQ has been very consistent and you can rely on it. The second reason to consider investing is the equity exposure with lower volatility. This fund provides equity exposure to the NASDAQ 100 index and dynamically sells call options, allowing for participation with rising markets and potential outperformance in negative to flat markets. This ETF in specific offers a very interesting strategy with the dynamic selling of covered calls, meaning that if the market trends strongly, there's actually potential for some significant capital appreciation, even though the ETF seeks distributions that are consistent and monthly. Last, diversifying source of income is the third reason to consider investing. They seek to deliver attractive income with a lower correlation to traditional income sources and their risks. One of the key benefits for this ETF is that GPIQ has one of the lowest expense ratios around at 0.29%. That's extremely cheap in general, especially for maintaining a strategy of selling covered calls and the active management that you're getting exposure to. We'll get into QQQI in a bit, but even GPIQ has an expense ratio of 0.35%. One thing to remember is that GPIQ employs a call option strategy at the money between 25 to 50% of your investment. Basically, this means that 50 to 75% of your investment can appreciate in the same manner as the main index fund, QQQ. Now let's talk about the income consistency of QQQI. QQQI utilizes the NASDAQ 100 just like GPIQ. The NEOS NASDAQ 100 High Income ETF pays monthly distributions, but with a much higher distribution yield of 14.42%. The major glaring difference here is the expense ratio, which is more than double that of GPIQ. QQQI is 0.68%. On one hand, you have a sizable difference on the distribution payouts, but does it make up the difference in the expense ratios over time? So as you can see here, 14.42% distribution rate for QQQI versus a 9.89% distribution rate for GPIQ. So let's learn a bit about NEOS strategy for QQQI. This fund seeks to distribute high monthly income generated from investing in the constituents of the NASDAQ 100 index, implementing a data-driven call option strategy. This is where this ETF really shines, in my opinion, because it brings in high monthly income, but it's trying to be as tax efficient as possible. Now with QQQI, it really depends on what type of investor you are or what you plan to be. One investor may not necessarily be concerned with the price appreciation, and they'd rather focus on the monthly income that they receive. The higher monthly income is definitely helpful if you have a lot of bills, if you're retired, if you travel, versus getting less income but more price appreciation. In this instance, you'd be an investor who's not dripping your dividend returns but just taking that monthly cash flow. Another investor may like GPIQ more because it has greater price appreciation, and they may not need the higher income at this point. They may drip the dividends, so they're just accumulating more shares in hopes of getting more money later on down the road. Regardless of what type of investor you are, there's no denying that this 14.42% dividend yield for QQQI is a behemoth. Just looking at this consistency has been amazing, and a majority of these payouts have been hovering anywhere between 60 to 64 cents, which is great compared to GPIQ, which averages about 20 cents less per share. So far, we've covered the income consistency, which both have shown that they're very consistent month in and month out. Obviously, QQQI has a greater yield, so you're getting about 20 cents more per share on a monthly basis. But looking at these side by side, it's really up to you which one is more of a preference, or maybe you invest in both. But either way, they're extremely consistent, and you can count on that consistent income on a monthly basis. While they do both have fairly short track records, their consistency definitely stands a cut above the rest compared to all the other covered call ETFs, something like GPIQ. Now let's take a look at the returns on the year to date based on the gain percentage and then the price point. QQQI caps their growth and appreciation in order to pay out that higher monthly income, 14.42% compared to the 9.89%. So it does concede appreciation to GPIQ. Now looking at the actual share price, their prices are relatively close. Yes, GPIQ has gained a slight edge on the year-to-date percentage gains, but at the end of the day, which is more important to you as an investor? Would you rather have a little less price gain on the year but more income, or would you rather have less income but more price appreciation? Either or, this is where investors can potentially invest a relatively small amount of money and see their portfolio grow over time. Obviously not as much as QQQ, but at least where you're earning a hefty dividend over time, month in and month out. Now let's talk about the tax implications and strategies that both of these funds use. Taking a look at QQQI strategy, the fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing NDX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. GPIQ and QQQI offer significant tax efficiency compared to other income ETFs, primarily because of its uses Section 1256 contracts, and a portion of GPIQ and QQQI's distributions may be classified as return of capital, which means that they're tax deferred until they're sold. Depending on your tax bracket, this could be very advantageous. These two are very similar in their strategies for tax implications, so it's really tough to say which one is a better fit for my portfolio. Now, earlier in the video, I talked about what would happen if you invested $10,000 into each of these ETFs. So let's take a look and see which one is going to be a better fit. First, looking at these two without drip turned on, you can see each returned roughly 30% with a 17 to 18% average annual total return. GPIQ has a slight edge in appreciation, which we already knew from earlier on, since their distribution rate is slightly lower, which gives them an opportunity for more price appreciation. Even if we factored in dividends for a total overall return, these two ETFs are almost identical. Total return for both is 33%, and QQQI returned just $30 more in ending investment total. It's safe to say that investing in either one of these is a safe bet for both price appreciation and income return. Keep in mind that neither one of these ETFs have a very long track record, and we've only seen them in the most current bull run market, with limited information. I know there's concerns for people about what would happen if the market pulled back, but looking at this chart when there has been pullbacks, since they're both based on the NASDAQ 100 and extremely similar in management, their charts look almost identical. Downside trends will hold these pretty close in action. I think these two are too close to call with such similar management strategies and such a short window of time for their trading history so far. It really could go either way as to which one is a better choice, especially when it comes to downside protection, as there's been very few pullbacks in the overall market to go off of. So at this point, which one is the better ETF to go with, and which one should you leave out of your portfolio? Truthfully, it really depends on what your investment strategies are. Maybe you prefer more price appreciation and less income because you don't need it right now. Maybe you prefer the more income and less price appreciation because you're retired or on vacation or need money for bills. For me personally, I own QQQI and I complement it with SPYI. But after doing this review today, I really can't make a decision as to which one of these two is better. I definitely am considering adding GPIQ to my portfolio. It does seem to offer slightly higher appreciation, and I intend to hold these ETFs for the long while. Let me know in the comments below, do you hold either one of these in your portfolio, or are you planning to add one of them? And if so, which one? To watch my last video on QQQI, go ahead and click right here. For more investing information, don't forget to check out my blog, link in the description below. Until the next time, have a good one.